Okay, I'm going to do a little bit of a quick market update. If you've watched my channel before, you know I focus on gold and silver in their relation to equities and printing and all that good stuff. So we'll get into it here. I want to show you a chart of where are we going? We're gonna go straight into silver. And we're gonna look at the NYSE, New York Stock Exchange composite divided by an ounce of silver. And we're going to look at that on a historical level. If we go to 1 month candles here, and we get rid of this just so you can see what I'm talking about. So here's the New York Stock Exchange composite divided by an ounce of silver. And if you have eyeballs and pay attention to the charts, you would notice that back here in June 2001 was our ultimate high of the New York Stock Exchange's relative value compared to silver. Now, since that June 2001 high, we've come a long way down. Ultimately, we had this, you could say, bear market against the precious metals from 01 to 11, where the stock exchange, the NYSE, lost 90% of its relative valuation against silver. Now, it's important to understand that we're speaking in relative terms, because if we go to the composite, NYSE composite, here is the September, June 2001 ultimate high against silver. As you can see from there, in dollars, the New York Stock Exchange has gone up 143% if you price it in dollars. But if we price the NYSE composite in ounces of silver, you can see from that same point, you're actually still down 50%. Now, why is that the case? Well, it's really quite simple. If you look at this chart, this is the money supply. Since we have 59 here is when I have the start of the money supply. So if we take a look at the year 2001, there was that ultimate high in the New York Stock Exchange's composite against silver. Occurred right here. Now in dollar terms, of course, the composite has gone up because the government's printed 343% more paper dollar currency units. Right? So we have 343% inflation over the past 20-ish years in the money supply. Well, if you look at it that way, these indices are priced in dollars. So it's no wonder we have this giant fucking push upward 147%. But if you compare this, if you take out the effects of inflation to some degree, because precious metals don't benefit from inflation like equities do. Because if you understand an equity, you would understand that it's a balance sheet of transactions that are taking place constantly. A company has cash and debt on its books, and they float, the debts with the cash that they're able to have as income. So what I'm saying is, all of the companies in the New York Stock Exchange have benefited greatly from the inflation. It's the same reason that cars and houses jumped up in value so quickly recently. If we go back to the M2 money supply, we can see that the start of COVID was right here. Here's when the COVID stimulus started roughly. And Since then, we've had a 35% increase in the amount of dollars in circulation. Um, so, there was the flash crash in 2020 from COVID, but since then, a lot of stocks are at new highs. It's because they gave away free money. It's the same reason your house is worth more, same reason the car is worth more, same reason the New York Stock Exchange Composite is worth more in dollar terms from 2000, but worth 50% less. Let that sink in. 50% less on relative terms than it was 20 years ago. And you know what's crazy is if we turn these levels back on, let's get rid of this guy. Here you have a head, shoulder, and shoulder, or if you want to make it even tighter, shoulder, shoulder, small head. But what it looks like to me is happening over here is you're getting another head and shoulders pattern around this neckline of your previous head and shoulders pattern, which would be very, very bad for the stock exchange. Last time we had a big head and shoulders and you closed below your neckline, which was right here, you still had a 78% move to the downside. Now, everyone can think what they want to, but this looks pretty convincing to me that you had one pump, two pumps up to a previous neckline. So you had one pump here, and then a sell-off, then another pump, where you went up and touched this neckline back in 2008, 2007. And we're getting a similar thing over here. Maybe this will squeeze like this, and you get one more pump and go down or something. Or, maybe I'm completely wrong about this being a head and shoulder. But, it's really interesting to me that in the past 20 years, relatively speaking, the average stock on the New York Stock Exchange is down 57% compared to silver. So let's look at it compared to gold, because the gold's version is going to be a little different. So we'll actually have to take this one and then reverse it. We need to invert this. Okay, so don't pay attention to this. This is essentially the same as this. This is the New York Stock Exchange Composite priced in ounces of gold. If you see here, we have a similar sort of shoulder, head, shoulder. And, back in 2001, gold's chart is a lot harder to read in terms of trying to make a head and shoulders pattern because it looks like a blow off top, more or less. But still, here's the ultimate high against gold. And remember, the New York Stock Exchange Composite is like 2,000 companies on one of the biggest well-known stock exchanges in the entire world. That being said, in relative terms, it's down 218% compared to gold. That's pretty depressing if you ask me. It's way up in dollars, but if you were to take the exchange and price it in ounces of gold, you're way down. And that just tells me that gold and silver are accounting for the inflation. They're hoovering up the inflation, because if we look at here was the ultimate peak of the New York Stock Exchange against gold and silver, denoted by this dashed or dotted yellow line right here. About 2000, 2001, about right in here. Since then, gold, priced in dollars even, has gone up about 650%. You're also making a bullish continuation pattern right here, cup and handle. That's a bullish continuation pattern. Normally you would see something like this if it plays to the upside, or something, along the lines of that, drifting up this way and continuing this bull trend. Why do I think that's going to happen? Because if we look at the structure of this, we can see that we're not really having a a convincing push above these levels that we saw back in 14, 15, 16, 17, 18. Here's COVID. There's June 2016. This doesn't look very convincing to me. One could still argue that this is your uptrend right here. You're going up, up, up this way. But it would only take a little spill right here for that to be invalidated. Something like that. But this is not, we'll have to see here. It's going to be make or break time pretty soon. Because if you get some sort of squeeze and rounding up this way, we have a bullish continuation pattern of equities over precious metals. If we do something like this and we start moving down more precipitously that way, then I can confidently say gold and silver will be continuing their bullish chart pattern. So this is gold's cup and handle. If we look at silver's cup and handle, it's looks much different. It's a much larger pattern. So cup, and then this will be some sort of handle over here if it plays out. Sorry, this cup is drawn really poorly, but you get what I'm saying. We'll have to see here how this plays out. Obviously, I think I know what's going to happen. And why do I think that I know what's going to happen? I will show you. I'm going to add. Now remember, this is a chart of relative valuation of the New York Stock Exchange Composite, priced in ounces of silver. We're going to add this to compare. And then we're going to take a look at something called the yield curve. And we're going to look at a chart that I've made. This is the US 2-year yield divided by the 10-year yield. So we have the short end of the yield curve divided by the long end. And we're going to do this. Okay, I got to move this to a different pane. I got to move this to a different one. Pen to new. New pane above. Okay, so this is easier to visualize if I just do it like this. Okay, so every blue dashed line is denoted a yield curve inversion in the stock market. If you look right here, this is that 2000 era, we had 2 yield curve inversions, and you can see the stock market took a big hit compared to silver, or the NYSE composite took a big hit compared to silver. Then we had these really easy rate policies after the crash, until eventually you touched again during COVID. Up here, your yield curve inverted, and then we're on this ever so slight downtrend. But unfortunately for the equity bulls, we had another yield curve inversion right here. We'll make it blue just to match. So we had another inversion right there. So I think the writing is on the wall in a historical perspective. The one era we didn't experience a down leg is we had an inversion here, and the stock market still rallied above gold and silver. But you can see from here, here, and this one, we don't have that much data to compare to, but we have 1, 2, 3, 4, 5, and we can confidently say that 1, 2, 3, 4 out of 5 times when the yield curve inverts, the average stock on the New York Stock Exchange loses value relatively quickly to precious metals. And that's because inflation. That's because gold and silver hoover up the effects of inflation while the companies bleed, since they were built up on, printed dollars that can just be printed to infinity. So right now this chart is showing, basically like an 80% confidence level that it's going to do something again like that. And if we go back to here, if we establish some technical levels for you to look at, here it is if we took log off. So let's take this off and let's get rid of this guy because we don't need it anymore. So if we take log off, you can see how disappointing this is, really. Because really what this really shows is all the bullshit from the dot-com era, the housing market crisis era, the COVID era. None of these fiscal policies that the Fed has done, whether it be Bernanke or Yellen or Gensler or Powell, any of them, you know, but it seems like it's horse shit to me. But, you know, I mean, look at that. Apparently you're in a bull market. If you go and watch the sound bits on CNBC or MSNBC, apparently the New York Stock Exchange is in a bull market right now. And if we go look at it compared to dollars, remember, mind you, dollars are pretty much worthless now because they keep printing. But if we go back to this, oh yeah, okay, makes sense. You know, we're only down 7-8% from our ultimate high back in December 21, January 2022. Okay, sure, and yeah, we've pretty much just gone straight up. But let's add that to compare, and if we take a look at the M2, oh, would you look at that? They're following a similar trajectory. That's because when the Fed prints, they pump liquidity and, you know, free capital into these companies. Like I said, it's the same reason your house is worth more. It's the same reason the cars are worth more. I mean, they're not worth more, okay? That's an important thing to get. On dollars, in dollars, which are technically continuously worth less, if you price something that's being devalued and defaced at this rate, of course it's going to be going up this way, right? Because they're just going to keep printing. But if you price the stock market in a real asset, something you can actually hold, if we go back to this, we have something completely different. So there is let's get rid of this and we'll move this to a new pane on top so you can see, oh wait, that didn't work. So, okay, this is a really good comparison. Here you have the New York Composite priced in dollars, pretty much just going up, just like the money supply. It's going up. Okay, let's price it in something that actually, you know, takes effort to make rather than printing, because we know they can do that whenever they fucking feel like it. Down. This is divergence. This is a huge amount of divergence. We have an uppy up here and a down, down, down here. Like, we don't need to be that technical. These charts look like the opposite to me. And we'll leave this up here and we'll compare it to gold. Let's just do so another interesting story being told here. So the New York Stock Exchange just keeps on chugging upward if you price it in dollars, because they keep printing dollars. But if we price it in gold, well, what the fuck is this chart? This chart is a lot more confusing now. I mean, you have this, and then this fucking sideways movement here. What's going on? It's a lot more complicated. Generally speaking, since the year 2000, you've gone this way, which is the complete opposite of this. But people aren't looking at charts like this. You know, gold bugs are usually old, you know, old school types of investors and businessmen. And, you know, gold and silver aren't glamorous because they don't earn a dividend. They don't earn you money. You can't necessarily leverage it. I mean, just think if you had 1,000 shares of some company on this exchange earning a dividend, and, you know, this exchange pretty much just keeps going up. So, you know, your dividends keep going up. But in relative terms, everything you're earning here is actually just going down, relatively speaking, to assets that have inherent value. See, gold and silver don't have any counterparty risk because they don't rely upon any paper fiat system to be functioning for it to work. Now just think of what would happen if over here we have the New York Stock Exchange. There's the 2007 crash. There's the .com crash. Here's the COVID spike. Let's just measure these for shits and giggles. That was 34-ish, 40-ish, 50, 25. So maybe we get it. There was a 19. I don't know. You'll have to interpret these charts how you want to, but it's pretty clear to me, I think, what's going on. You know, the more you print, the more your paper stocks are worth, the more these companies are worth on paper, but in relative terms to something that has inherent value, it's worth less. Think about it. And I think we'll see another 20-year cycle like this play out. I don't think it's going to be a bull market for the stock market against gold. So here is from like, if we look from 80 to 2000, there's a 20-year bull market in equities against gold and silver. That's this portion right here. Then it entered a 20-year bear market in relative terms. If we look at that 20-year bear market, you pretty much just went sideways in dollars. But in ounces of gold, you went down 85%. And then, you know, this little jump right here, you went up from, you know, 2010 to 2023, you went up 100% compared to gold, and 130 something percent in dollars. So, you know, you can stay in the stock market if you want to, but I think you're in for another round of this section right here. I think this is going to curl over and you're going to go down here, which would probably mean the stock market kind of just waffles sideways for a while and then continues its uptrend because they're just going to keep printing. But you got to think about what you're buying if they can just print it nonstop all the time. This, I think, will precipitously go lower and lower in relative terms because you can't print more gold. Gold has pretty much only gone up if you really look at it historically. I mean, it was illegal to even own gold back here in the 70s as an American citizen, I think. I heard Robert Kiyosaki say that. I don't know if that's 100% true. But yeah, okay, so stock market go up, you know. Gold also went up. But this one over here doesn't have any counterparty risk and you don't have to deal in paper markets. So, I don't know, food for thought, people. You can do what you want to. They're going to probably keep printing money, but the money's going to be worth less per dollar, but your assets, like, you know, the fucking car, the fucking house, are going to be worth more in dollars because they keep printing it. So as long as you guys get that point that I've stressed a bunch, then I would say this video is over. So peace out.